officially welcome. This is She's Independent's Intro to Angel Investing series, and this is our second session. Today, we're going to dive into all things, what happens around allocation? What do we look for? Maybe some flags. What does diligence look like? So many things to cover. And I just want to remind you that in today's session, we're not going to be able to cover everything, but this is really a nice forum to start covering material that are, whether it's foundational concepts or some deeper, insights, things to get you started. And I'll give you a little bit of background on myself, and She's Independent just in kicking this off. But first, if you didn't join us for the first session, it was those foundational concepts. It was, what is angel? What are different investment vehicles, or what are you seeing in terms of what raise stage might you play in? And if you missed that session, if you're interested, we of course still have it available and accessible. I'll send a link in a follow-up to those who joined today so that you can access it. And then we have a third session as well. The third session, which is going to be happening in June, is going to be writing the check, what to expect, portfolio. But today it's really about, that capital allocation piece. Quickly, if you didn't join that first session, I'll tell you just a little bit about myself. I've been angel investing for over a decade, and I've also spent time in institutional finance, meaning on the professional financial side of things. Oops.
Please try again.
Siri is talking to me, which is very odd. She clearly wants to angel invest as well. But anyway, I spent time at a big bank. I spent time in private equity. And what this basically allows me to do is not only have a track record where I actually have exits and an interesting portfolio already, but the way I show up is I want to share real skills from financial professionals. I'm not sitting here as a wealth manager saying, do this, do that, or, I'm going to allocate for you, but I'm going to provide you with those insights based on the experience that I have. I will say, if you're reading the slide, I do have a pretty ridiculous track record where, some of my early investments saw a really, high return of over 20x on average. By no means are these, discussions to say, invest in angel, you're going to make a bunch of money. That's not what this is, right? We talked about it in the earlier session, but it's really great for, learning access, maybe improving or pathing, to a new career or board seat or something else of interest. But by no means is this something where we're going to promise you any return. So just want to make that clear. In terms of what we're going to cover today, first, I will say, if you have questions in real time, raise that hand, speak up, drop it in the chat, recognize that some of this may be very new for you. So first, bravo for being here. Feel free also to drop in the chat, if you want to say why you joined or showed up today, or if you have specific questions. But this is really about, making sure that what we cover, you can learn from. And so if you are confused by a term or an example, again, engage. And of course, we're going to have, some time for Q&A later. But if there's something in the moment, I don't want you to get lost. So I encourage you to speak up. We're going to talk about or dig into, what we look for and what I look for as an angel investor and as our group. We're also going to look at specific examples as it relates to diligence of, well, what actually happened? I think earlier when we were positioning this, we were calling it case studies. And, at the end of the day, I think giving you representative examples of what actually happened, when we made that decision, what were some of the flags or what were some of the things that we worked through? Really interesting for you to see. However, I want to tell you that Rachel, who's on video, if you want to wave Rachel, she is our VP of deal sourcing at She's Independent, our women's investment group. All welcome. And when you actually start plugging in, whether it's with us or with someone else or, a group that you're already a part of, by showing up on a deal by deal and learning in real time, you're going to learn so much more. So this is really about introducing some things, giving you examples, but when you're actually in those deal rooms, when Alicia is co-leading diligence or, jumping into a screening call, those are really the rooms where you're going to get the deepest knowledge. So this is great. So glad you're here. But I guess what I'm saying is there's a lot you can learn, outside of this room as well. So I want to kick this off with, what's your investment thesis? And let me tell you, as a right here engineer mathematician who started on Wall Street and had, I don't even know how many financial internships even before I graduated, it has taken me years and years and years to even begin to assemble that. And this is what I feel good about, and this is where I feel strong. What I'm saying is, it's okay if you never get there, and it's okay if you don't have a thesis, and it's absolutely fine if you say, I'm interested in this. And it doesn't have to be a thesis. I'll give you an example. One of the women that heard me speak at an event, a really great event yesterday, she reached out and said, wow, I heard of this, women's health organization that you're investing in. And, you mentioned osteopenia, postmenopause. I'm dealing with this thing. I want to invest. Wow. It's something that, touches her. It's something that, is very much something she's dealing with. And the fact that she's able to allocate funds towards that, it's a kind of mission aligned thing, tremendous. But did she come in and say, it has to be this stage and it has to be this type of, traction? No. So you don't need an actual thesis that narrowly defines, I have to go for this stage, I have to go for this industry. But it's absolutely fine. And it's great if you want to develop that. And so, sector, stage, allocation strategy, these are all things to think about. What does that mean, right? Sector, what industry? I never thought I'd be making all these healthcare investments, but in our investment group, because we have such a widespread, knowledge base and expertise from all these great folks that are a part of it, we've started seeing tremendous deal flow and made decisions to, ultimately allocate to some really tremendous healthcare investments. Wow. I just expanded my sector interest, right? Or focus. Stage. We're typically investing in seed plus. What does that mean? It means there is some traction, there is some execution, doesn't need to be, a bunch of sales, doesn't need to be any sales, frankly, but it means there's some execution. But sometimes we're investing at Series A or even later. Why? It might be the time that we, had the opportunity, met the business, and, saw that alignment. So we have a little bit of a wide, I'd say, scope in terms of how we're investing at She's Independent and how I invest personally, but there are things we absolutely look for, and we'll talk about that. Allocation strategy. Personally, as an angel and also as an angel group, we're often allocating, once. A lot of really phenomenal VCs out there are going to have dry powder or money that they can allocate after. Why might that be great? If you are invested in a business and you're seeing them execute and you're seeing all the traction and all the things that they're doing, if you can write another check, that could be really powerful. So some of the best VCs out there, I'll give you an example, Primary Ventures, in New York, they're following, teams for, years before they allocate, and then they are allocating again based on what they see. If we are angels and we only have a check that's collectively $100,000 or individually, $25,000 or individually $5,000 because I'm investing, with another group like She's Independent, is $100,000 going to move the needle if they're, raising 20 million? Do they even want our check for 100,000? Maybe, but there's a reason why we may not be allocating again and again, later on as angels. But institutional money, VCs, private equity, that's a different approach. And you can develop that investment thesis alongside investing in deals with others who have experience and expertise. So in terms of what we look for, this is a really key piece of it. It's, what ultimately gets Rachel's ears to perk up. I believe Idong joined the call. Idong's another one of our deal leaders, right? Idong may say, you know what? I love health tech and I love, women's healthcare, but that one just doesn't interest me. What gets us to perk up? Team and story, I have first. When you're talking early stage, team and story are critical. Critical. We have more slides to talk about all these points. I just want to say team and story, don't forget that, right? Risk reward profile. If they're raising at 20 million and the exit's only going to be at 50 million and it's risky, that's tough. If they're raising at 20 million and you see line of sight to a really big market exit, maybe 200 million or $1 billion, and it's high risk reward, you have that uplift of it's not just a 2.5x or whatever, but you can actually make something on it. So if it's a medical device company and they can only exit at 50 million, right? And that's what they talk about. They better not be raising at too high value valuation, because again, that risk reward, you have to think about, what is the risk and where can you ultimately exit? Need and demand, ownership. We're going to get into these in the later slides. All right, I'm still figuring out this new view I have on my computer. There we go. So let's talk about story. And it looks like my image fell off the slide. So you can, in your mind, create the story, the vision, right? But basically, when a founder or a founding team or the CEO or whoever's doing the raise, when they pitch you, they need to move you. They need to sell you on the dream. I don't want it to be so unrealistic and so out there that it doesn't make any practical sense. But why is this going to happen? Why you? Why this team? But what is it? Right? What's the vision? Because especially if you haven't built the product yet or you don't have sales, this is early stage. What's that thing that's going to, get folks to allocate and give you those millions of dollars or, hundreds of thousands of dollars? If you don't have a good story, you're not going to be able to raise in the early stages. And by the way, a point that came up the other day from a really seasoned angel that I had on a panel at Boulder Startup Week, I loved the point he made where he said, a story isn't constraining you. If you're talking about numbers, this was the sale, this was the, the budget, whatever it is, then you get trapped in that, the numbers matter, don't get me wrong. But you're not constraining yourself with a story. And so I'll give you the analogy of this. If you have a sales background, people aren't buying because of the price. They're not buying because of that feature. They're buying because of maybe how it makes them feel. They're scared if they don't have it. So there's all these reasons why you don't want to just talk about price or features, right? What is the story? And we don't need sales when we're investing. Like, we don't even need a product. We don't need a line of code, but we are looking for some execution. We'll talk about that. Team. Who is the team? They don't need multiple prior exits. Hey, if they have prior, exits, great. If they have prior failures, I'm good with that as long as I'm seeing growth and evolution and they can speak realistically to, and this happened and this is what we're doing differently, right? That's huge. Expertise and grit are right up there for early stage in terms of really, really key things, critical things that they need to have. Expertise, right? Why you, why your team? Do you have the chops? Are you able to do this? More recently, I chatted with a founder team and it was a really interesting product idea. By the way, they didn't really know how to sell the vision of the story, but they didn't have expertise on the team. And I'm like, how, this just doesn't make sense. And it's okay if you have experts that are a part of it, a part of the core team, but just you need to see within that founding team or the, the key critical people there, they can do this. And grit, because failure is inevitable, or, pivots, or, having to change pace or getting no. Building a business is really, really hard, especially at those early stages. Why are they going to have the staying power? Why are they going to make this happen? And this is a big one, but if you see limitations, CEO, founder, whoever's doing the raise, and you say, you know what? Maybe they can raise a seed plus, but I don't see them raising a series A, series B. And they're talking about wanting to bring this business, to something big. Are they going to be able to step back? Are they aware of those gaps? Do they have the hubris of, I need to do everything? So understanding these people, critical. And another big one in the team is, who else is on the team besides the executives? And what are your hiring plans? I can't tell you how many times you see a deck or you hear a pitch and it's, all right, well, we need the, million or 2 million. And yeah, we're going to put some money towards, personnel and hiring, but they don't know anything about, they have no plans. You know what I love is when they say, and we're already in conversation with, and we're ready to pull the trigger on, we already have identified this phenomenal resource and they're ready to join us. Right? That's execution before they actually sign the agreement. Thoughtfulness, they're being intentional, they're being strategic, all those things. What else do we look for? Go to market, excuse me. And, if they have dollars. But let's start with, is there an actual need for the product or service? Because how many of those founders out there, they're like, well, I thought this was a great idea and I'm bringing it to market and I'm building the thing. And it's like, wait, how many potential customers did you talk to? Oh, well, you're getting interest. What are they going to pay? Crickets, right? You have to know, have they tested the market? Have they really done the research? And by the way, oftentimes in these healthcare investments, it's somebody that's like, anecdotally, I believe there's a need, but what is going on? What is the validation? Because if you build the thing and you build it wrong, or you build something that's not needed, it's not going to sell. You know what I love about this company that we're investing in and allocating to right now? In our group, which is predominantly women, we learned about this product and every hand went up and they said, I want it. I want it for my mom. I wish I'd had that. By the way, it's not a sexy product. It is a in-demand product. And you want to invest in that one every time. Okay. Don't go for the sexy thing that gets you excited. And you're like, yeah, the future's AI and machines are going to do this and that, in 10 years. What's plausible? What's feasible? And gosh, if people want to buy this thing today, even if it's not sexy, invest in that. So if there are dollars, if there are customers, right, there's a lot more you can dig into. Conversions, retention, what does the sales funnel look like? Are you getting great inbound business? Amazing. What's your plan to make sure that you can scale? And it's okay if you don't know, but do you have ideas? Are you being creative? Can you speak to a story of, well, this is what we're going to try? And what we look for in terms of ownership, right? The money on the table. Who else is investing? This is a big one. First, it's okay if they're going to change their fundraising strategy or their scaling plans, but let's understand what those look like. Again, is it realistic? You're only going to raise once and then you're going to be a unicorn. You're going to go public. Okay, slow down. Let's talk about it, right? Because you're probably going to need a lot of capital to scale. And sure, they don't want to give away, maybe too much ownership in that journey, but let's be realistic here. And let's understand when they're fundraising and you're asking for those updates and they say, we're soft committed, meaning people have said they're interested and they're thinking about it, versus the hard commits, the committed capital, people that actually have agreed, I'm going to write the check or I did write the check. Understand what that looks like. Because if they're raising $5 million and they're under $1 million, commitments, or they have soft commits and they have no lead, meaning nobody that's leading the round and making sure the terms and, kind of buttoning everything up, which a lot of people require, that there's a lead investor. It's going to be really hard for us to allocate if our check's only $100,000. Don't be the first check. Don't be the first check unless you're ready to write off that investment, right? Because if somebody's out there and they're saying, well, we have all this great stuff lined up and this and that, we need to keep the lights on. Just be aware of what you're signing up for. Runway and burn. How much cash do they have in the bank? How much are they spending every month? If their burn is $50,000 or even $20,000 and they only have $20,000 in the bank and we're writing a check for $100,000, that's not getting them that much runway. In a market where it's tougher to raise, which it continues to be a tougher market on, some of these private funding rounds, the runway and burn matter. What are their plans if, they can't complete the raise? Maybe they're only at $1.5 million of the 3 million they targeted. Can they keep the lights on? Can they make it happen and scale back burn? Like, what are their plans? And something we talk about all the time is valuation is just a number at the end of the day. The valuation, I know some angels and they say, I'm not going to put money in if it's over 20 million in valuation. But that's nonsensical. If one company has the potential for a $50 million exit and another one has the potential for a $500 million exit, right? So think about, with the valuation, it's basically where are investors coming in, right? What's the valuation? And for private companies, which is what we're talking about, evaluation is truly where those meet. It's where will the company, give away equity and where will new investors come in? or existing investors, re-up. And that's the valuation. Think of supply and demand. And to talk a little bit more about ownership, who else is investing? Because if it's a bunch of angels or a bunch of family offices and none of them have expertise in this space, or they don't have dry capital, meaning they can't write another check after, that's going to be a little scary. But if you have strategics or institutional, meaning potential acquisition or potential acquirers, or institutional capital, meaning when I mentioned the venture capital where they're going to write a check behind if they see execution, that's that path to setting up that kind of baseline for, yeah, I'm going to be able to raise, I'm going to be able to scale, I'm going to have that, those folks that are going to help me get there. And I'm not saying every institutional player, every strategic is going to, reinvest, and it depends on what the company's doing. And sometimes they want to bring in new investors alongside their existing investors. But the point is, who else is playing? And one of the other reasons we love institutional capital at She's Independent is we're smart. We're doing our diligence. We're asking the questions. But at the end of the day, we're not being paid to do this stuff. And we're not going to pour over every number in that, balance sheet or every number in that data room. We are looking at all of it. We are going to ask questions. But institutional capital, where they have management fees and, a lot more to allocate to this stuff, and they go deeper, it's just another check of, great. They've also looked. They've also, done, further checking, much deeper dives. Last piece of this slide, and I realize it's not really about ownership, but it says, what does the board look like? Listen, for early stage companies, this may be just a moot point. It may be the founder, maybe it's, a one-off individual with expertise. Ideally, it's not going to be actually even numbers, so maybe 3 people or 1 person. But the point is, the board's going to matter more and more in terms of the company, progressing along. But even for early stage, the board still matters. And why am I saying that? I have seen companies fail, gridlock, they can't, get out of their own way. Some people have board seats and they're just stopping votes. They're stopping things from happening. And so the board, and understanding if it's a working board, if it's a helpful board, still worth asking. And actually, we have an example of this later on, so I'm going to move on. So I know that was a lot before we talk about our diligence process, and this will be just an hour. I know that's what we booked for, but our diligence process is digging in and getting a lot of information, but also recognizing it's not going to be, every number, but it is going to be reviewing all of the information that we can get our hands on in a reasonable fashion. We're not going to have 3 dozen calls with the business. Frankly, we're not even going to have half a dozen calls with the business, but we are going to have a lot of emails. We are going to have phone calls. We're going to do calls with, customers or prospects or partners, other investors, team members, potentially, maybe investors that didn't invest or didn't re-up. We're going to look at that data room. We're going to talk about what is a data room. And we're looking at qualitative and quantitative. It's not just numbers at the end of the day. And it depends on what kind of investor you are. But let me say this. If you see bad culture from the top, you see, misalignment of, how they're showing up, and you don't think they're going to be able to have and hire a good team or scale the business, that's stuff to listen to, whether you want to call it gut, whether you want to call it all the data points that are getting, processed in your brain. It's not just what's in the data room. It's also the qualitative. Is this reasonable, right? Does this even make sense? So we're going to give a bunch of examples here. And quickly, I'll say with our diligence process, it typically takes about a month. So after, the pitch, and after we say we're interested enough, it's typically about a month of digging in and doing these various things. We're going to give a bunch of examples so that, again, you can get more of a sense of what has diligence looked like. How have we participated, and what, did we ultimately do in terms of the investment decision? But first, let's break down the data room. So the data room, most companies, almost every company that's raising is going to give you access to this. And it's basically financials, examples like case studies, testimonials, all these things. The cap table, meaning the ownership structure of the business, maybe deal docs, maybe not. Maybe you get those closer to the deal. You should ask for them. But basically, after you hear a pitch and it's all great and it's all rosy and it's, yeah, they said this in terms of pipeline, they said this in terms of forecast. Now you can actually see the numbers. Some may require that you sign an NDA before you see it. It's, typically something they say it's confidential, it's locked down, but it's a bunch of information to move you from I'm interested to hopefully, well, they're hoping that you ultimately allocate. The data room may also include things like IP, grants, right? Another category, which it depends on the business. Not every company is going to have non-dilutive funding or grants. Tax credits. We love tax credits, right? That's something that we sometimes find. And we'll get information around, well, what is this and where is it applicable, before we actually invest. The other thing I want to say here is be proactive. Same with deal sourcing. Don't wait for it to come to you. If they're just feeding you the information, it's going to be the story they want to tell you. But as you know, you want to define or you want to be proactive. So it's, well, where are the gaps? What are the risks? And that's why when we're jumping on investor calls and we say, hey, we'd love to connect with a few investors, which we may also back channel, find people that they're not, recommending, we're actually going to call out, can we also speak to investors who chose not to allocate to this round, who allocated to the last round? Really good information, right? Don't shy away. Ask the questions you need to ask. Get the information you need. I love our approach, our investment group, which is creative and collaborative. Folks with different expertise, different viewpoints. Some might have an IP or patent background, right? Great, love it, because that's not my area of expertise. And again, healthcare, right? That was not my area of expertise, but when we have MDs and, experts and folks that, play or work in health tech, that allows us to operate and due diligence and make decisions at a deeper level. So by being a part of a, group, or maybe it's a few people you invest with, you really can share that collective insight. And we share it around our diligence process. So we may have 2 or 3 people that say, yep, I'll help with diligence on this one. I'll co-lead or I'll lead it. And it's not one person. It's not a single point of failure. But we're also open to all of the members in our group who can kind of weigh in and come up with questions or, participate, even if they're not leading diligence. And after diligence, we're getting to this investment decision. We're still going to come to the examples in a minute, but the investment decision is really important because when you go through diligence, you don't want to say, no big red flag, like, okay, let's allocate. You need to come together and you need to say, okay, do we remain excited? Did it really check out? Now that we know more, how do we feel about the risk reward? How do we feel about the story? How do we feel about, is this something that can actually happen? We had a business that, we looked at and we were really excited about. And at the end of the day, there weren't even red flags, but we just got less excited. It's probably a bunch of things. It was, some of the demos we saw and this and that, but no actual flags. We just lost excitement. Do you have enough interest to move forward, right? It's not just about flags, but we will talk about flags. Some flags, and I have, in parentheses, red, some flags may not be red. They may just be flags. You may say, you know what? Hold on, let's pause here. Ongoing raises with no hard commits. That's a tough one. Could be a really tough funding environment. But if they've really exhausted the market and they keep punting and they keep punting and, there's just not investor appetite, that's a really tough one. Super small checks. If you are very strategic, if they're, really like, hey, this person has the expertise and no matter what, I want them on the cap table. Exception. But if they'll take $2,500 or $1,000 from anyone, that's a problem. Why? Institutional money, right? The players that are coming in with big checks, they don't want to see a million line items on that cap table. And there are restrictions and restraints around how many people can be on the cap table. The way that we democratize that access and allow you to come in with small checks is we come in as one line on the cap table, one line item. We create an LLC or an investment vehicle. But if they're taking really small checks, you got to scratch your head. Why? Why are they jumping on, and offering all these calls with you and you're writing a check for $5,000? Check for 100,000 is different, and we can make intros potentially to other investors. That's different. But ask yourself, right? Why are they trying so hard to get that 5,000 if they're trying to close $1 million or more? The third point on this slide, I don't know how many of you are getting this kind of outreach on LinkedIn, but I get so much where it's write the check. I'm going to give you a board seat. They know nothing about me. I mean, they see my LinkedIn profile, but you need to be really wary of, right? People that are just kind of throwing things out there and just trying to get money in the door without any vetting, without any alignment. You taking a board member, that's a multi-year commit, typically, right? Are you even a real business? Why are you trying so hard to close this money? I mean, it's an odd thing that I'm seeing more and more of, so I want to call it out. And wild assumptions is another one, and we have some examples of this later. But if it doesn't pass that gut check, listen, ask questions, right? So we're going to jump into a bunch of investment scenarios, and I think this will be fun. We're going to share real world examples of investments we looked at, what happened. So one of those outlandish, I'll say, assumptions that was shared was a company more recently that we were so excited about. And I'm not going to call out the names. I want to keep some, anonymity here. They said, oh yeah, we'll be break even in 3 months. And all of us kind of just eyeballs out of our heads. Rachel, I don't know if you remember which one I'm talking about. Don't say the name. But after the pitch, when we had that frank conversation as a group, we said, no way in hell, right? If you have a path to it and you're being positive, that's different than completely outlandish assumptions. And we've heard the break-even ones so often. And listen, it's totally fine if you don't meet the goal or the timeline of what you're saying, but it needs to be somewhat reasonable and realistic. We did not invest in that business. And again, let me say, it was the one we were most excited about going into pitch day. Sales estimates. A company that we just evaluated or ran diligence on, really liked them. And there were some questions of, wait, how are they going to go from 0 sales to 1,000 sales month over month? Crazy, right? Well, there's a path, there's a line of sight to it, I'll say. A ridiculous amount of demand. Again, that's the one where everybody raised their hand and wanted the product. They already had the manufacturing, happening. They already had products in hand. So it made sense. Do we think they're going to hit the 1,000 that first month? I don't. But it's not like they didn't execute and they don't have a line of sight to it. So we're investing. But digging in and asking the questions, what is manufacturing? How are you going to scale the thing? Competency. This is a tough one. We talk about this one on our, core deal team. And by the way, in our group, we have weekly deal calls where anybody can drop in, anyone can become a deal leader. But Rachel and Idong, who are on this call, are two of our de facto, leaders of all things deals. It's a tough one because if somebody doesn't demonstrate professionalism or their email communications really leave something, you won't necessarily ever want to give them that feedback. You may want to be careful about, some of the things you're communicating, but it's stuff that we talk about on our end. That can be an issue for just how are they going to execute the business? How are they going to, complete this fundraise? One of the founders, we really like the business. She was sending us unreadable files multiple times. And there was, forget how many spelling errors. It was just so clear that she wasn't, she was doing so much, but she wasn't executing on the level we needed. And it's not that you can never make mistakes, but there needs to be some level of competency that we're seeing. So that was a deal we did not invest in, where we said, you know what? We're just seeing too many holes in terms of gaps with this founder. Another scenario, the CEO isn't the founder. This can be an interesting piece to dynamics or the board or, influence. So in this case, we said, wait, the current CEO doesn't have a huge, stake in the cap table, but we see that it allows for her to, step into a lot more equity based on, hitting certain milestones. Great. What does the board look like? Is it functional? Is it helpful? We dug in. The alignment was there. We invested. Because if the former CEO, the founder, the original founder, if he appointed, people to the board and they had a very different vision than the current CEO, that could be a problem, right? That could be a divisive gridlock scenario, but we vetted it. We still invested. I keep saying cap table. Let's define it, talk about it a little bit more. The cap table, or the capitalization of the business, it's all the owners. So who has equity, who has ownership in this business? A messy cap table, I made a point earlier of, a lot of these investors and also a lot of founders, they don't want to have a bunch of line items. Why? Number of reasons. Technically, right, you could have these investors showing up at your doorstep and saying, hey, give me updates, and just being really annoying in your ear. You want to be aligned with your investors. You don't want a bunch of folks that are just kind of barraging you or annoying you or, not adding value. And then every time you go through a funding event, or if you have a liquidity event, these are all line items or participants where you need to ultimately report to them, or, work with them, keep all the information updated. It's whether it's paying them, whether it's distributing K-1s, tax documents. So one of the companies that we looked at had a really messy cap table. Well, I should say that. They had a messy ownership situation. Let me define that. They started as one line of business. And then after years of amassing data and saying, you know what, this is a great business, but we need to pivot. We need to get more into SaaS. We need to get more into, analytics. Their old business required a lot of capital. It was very capital intensive. And the pivot to the new business was one that required new money or additional funds, but required also a recap, meaning they had to change the size of the position from those original investors to manage kind of expectations and valuations and all the things to raise at the current place. So they basically had to downsize positions of earlier investors. This is something that can happen, a recapitalization, changing the structure of or the ownership of the cap table. The business also had a shorter runway, pretty short. And by the way, their position, you had to dig in to understand it, because they were raising on a convertible note, which means with a convertible note or a safe, you can basically raise over a period of time, continuously take in money. It's not one close, it was a rolling close, but they're spending money as they're raising money. And so even though they positioned that, hey, we've raised, $1 million+ dollars, they'd spent the money. And we only learned that because we dug in. We still invested. Let's talk about this. Messy cap table, recap, shorter, runway. The mission alignment couldn't have been better. The integrity, the connections, just the ability of that team, the executive team, unwavering. And it was through a trusted network also that we knew them. By the way, institutional money, people that, are allocating on behalf of others, most of them, this would be really, really tough for them to touch. Meaning this type of situation, whether it's the messy cap table, it's the recap, it's the shorter runway, they have things that they can't look the other way on, right? Nice thing about being an angel, you can be flexible. You want to know your risk reward. You want to know what you're getting into. But thrilled about this one. We invested, remain excited about it. And by the way, they needed a pivot, meaning they were changing their business. They'd already started changing the business. So it wasn't the risk of, we want to get into this new thing. They already had started building and we're basically there. So just to mention that, it was de-risked a bit. Team dynamics. This one made our skin crawl. We had a business that was pitching us, and the CEO kept getting talked over by their chief science officer, who was a man. And it happened to the degree where all of us were just kind of like in our seats, kind of, fidgeting around. And when it came to the frank conversation after the pitch, when the company was off the line, we just went after it, and we're like, is any, did everyone notice this? Is everyone uncomfortable? Like, what do we think? Really interesting scenario. Gender dynamics, I'm sure played in, but personalities as well. The point is, we didn't say no immediately. And what I loved was we had a woman of color in our group, Black woman said, I'm in healthcare. And let me tell you, in healthcare rooms, that chief science officer, that's how people want to hear the company talk. And they're not going to hold back checks. It's not going to inhibit, or stop this company's success, these dynamics. We're appreciative to get that insight. We still did a bunch of back channeling, did a bunch of diligence to find out, well, what was the culture of that business? Does the CEO feel disrespected? Is she okay with this? And we found out this was an intentional strategy of how she was cultivating and empowering and, getting folks on her team excited. So really, really fascinating and interesting. But we created, I don't know how many spaces, multiple spaces, private forums. I had an offline conversation in person when I was in New York at a bar, really dug into the thing. By the way, I know her from prior life. We were friends many years ago in New York. So it was an interesting one. But the point is, if you find those, you have those gut checks, you have those things where you're like, this could really be an issue. Because guess what? Executive teams that are butting heads, that can be absolutely shutting doors of a business, right? You have to vet this stuff out. We were very excited about that investment at the end of the day. Another scenario, no data room. This is a unique one. If they're coming out of maybe a really great accelerator, you already see execution. They're already, almost closing their funding and they literally didn't need a data room. They're raising on a safe, which is, very standard terms. For all these reasons, we've still sometimes invested. Be wary. If you don't have, if there's not a high caliber or the integrity of, some great accelerator or network that you met them through, there's just less diligence you're going to perform. So be wary. You can still talk to other investors or customers or prospects, but sometimes there's not a data room, early stage. It's up to you. Maybe that doesn't make you comfortable, but again, there are still ways that you can, check and look for different information that's really key. All right, so those are our investment examples. I'm hoping, that some of those were really helpful to get you understanding how we think. There's so much more to explain. There's so many, a million, kind of scenarios and creative things that we could talk about, but we just wanted to give you some examples. If you go through that process of diligence and you're ready to fund the deal, what happens? Our investment group, we form what's called a syndication. Others may, form a special purpose vehicle or SPV. And at that point, when you've decided we're going to invest, we're creating that legal entity, we're taking the funding from investors. We've given them deal docs that say these are, the terms that govern, the investment through this investing entity that we created. Additionally, we're executing deal docs with the business that we're investing in. So I guess to break that down or just say it again, it might be confusing. There are deal docs that the investors that invest with us are signing that are between She's Independent Investments and the individual that's investing, for example, Rachel. And then there's the investment docs, deal docs between She's Independent and the business. The deal docs between us and the business are going to say, this is the instrument, this is maybe the valuation or the terms, maybe there's some conversion amount. And we talk about this all the time in our investment group. We talked about it a little bit in terms of the foundational session 1. But I have in parentheses here, tap an expert, and I just want to call this out. If it is not a very simple investment vehicle like a SAFE, Y Combinator, which is this accelerator that's been around for many years, developed what's called a SAFE, which is kind of the simplified form of, convertible. You really want somebody with expertise, whether a legal background, ideally somebody with, VC legal background. We have somebody like that, Aravinda within our group who's tremendous and she can review this stuff, but understanding, are you getting what you need? I'm not saying be egregious, but you don't want these to be predatory against you as the investor. I'll also say that with regard to if you are investing with a group, we are very investor friendly. We are doing everything we can to keep, fees down and all of that. Our syndication fees, as an example, when we group invest, it's $4,000 per deal. A lot of groups are $8,000 to $10,000. Just understanding and having that transparency, right? Ultimately, we're wiring funds to the business. We're invested. That's how the funding process works. But it's a lot to maneuver, a lot to navigate around. So that brings us to the end of today's session. We have regular office hours where several on our team, Dr. Edong, Rachel, myself, will kind of pop in and be able to answer anything in terms of membership with us or how we're investing, how we're allocating, all those things. And of course, you can sign up for emails and join us for session 3 if you have interest. And then we also have this Intro to Angel worksheet. So there's a QR code up if you want to check it out. So yeah, that's what we had prepared. I will stop the screen share. And I know it was a bit of a quiet crowd today. I'm hoping you were so in awe of all those examples. You were just kind of scribbling things down. But if you have questions, if you want to, bring up anything specific, more than welcome that. Scribbling for sure. I love that, Katie. All right. Latha asked earlier, curious about dilution and its impact on early angel investment. Great question, Latha. So what is dilution? Dilution is a company raises and you come in for, I'll make this up, $100,000 in that $1 million round. $1 million, I shouldn't say $1 million, $1 million valuation. So you're 10% of the cap table. You're going to assume that if you invest at these early stages, the companies are going to take more investment, probably numerous times. Each time they take more investment, what happens is something called dilution. Meaning, even if they're raising at higher and higher valuations, your position's growing, your position's also shrinking in terms of percentage of ownership. If you don't re-up, if you don't write bigger, more checks, you're going to be a smaller percentage of that pie, but ideally, right, the pie is growing. And so your position's growing even as you become a smaller percentage of the pie. I'll give you an actual example. One of my early stage, investments, and this is not something that you should plan on, but I wrote a very small check, $10,000, and they raised 5 rounds after that. And ultimately, even though my percentage went down each time they raised, my $10,000 became $700,000 because they had some massive valuation. So even though my percentage went from, let's just make something up, it went down, by 80%. I still had that much gain because the pie was so much bigger, because I invested at such an early stage. So anti-dilution is basically something that some people will get in different, employment contracts, or frankly, even as an investor, you may have a clause that says you need to give us the look on the investment so that you can re-up, you can keep your position whole or keep that ownership. Are you going to want to write bigger checks? Maybe not. Maybe you want to write a partial check, not keep the full position that you had, but maybe throw something in the game. Those are clauses that you can have in the agreement. Great question. Edong and Rachel, if you have any, and I know I didn't prep you on this, any thoughts, any examples of things that we didn't cover, if you're like, oh my gosh, I want to share, something that I didn't think we were going to invest in and we did, or we liked something and then we said no, feel free to rack your brains or just share any thoughts or feedback as well.
I would only emphasize the group discussions about deals really open up my mind to directions or new considerations that I hadn't had before. So I, again, I have a marketing background. So suddenly I'm doing deals in e-learning and medical devices, but I feel okay about it because I have other people in the group that either work clinically or have experience, getting a device to FDA clearance to sort of walk me through and reassure that what the company founder may be saying is in fact, true and believable. Idong?
Yeah, thanks for a great session, Natalie. Very informative. Yeah, I would say on the diligence side, it's kind of similar to Rachel's point. Like, I think what I've found very helpful is that diversity of perspectives. Because sometimes like we're filling out the, like in our group, we have like the chart that we fill out and, asking key questions as part of that diligence process. Like there's always something that you miss and, having somebody with a different background, different expertise comes in and they ask questions that you wouldn't have thought to ask. I think I think that's one of the things I love the most about, the She's Independent model, because you have those different perspectives and just being able to catch things early, or something somebody said on a call and then you go back and you look at the documentation as well. It's like, no, it doesn't quite match what you see in the data room. And I think that, that ability to have multiple eyeballs looking at things, I think really adds to that diligence process. Yeah.
Yeah. And
I had a question that I wanted to add. I see the questions coming in the chat, but the question around clarifying between so you said some groups do an SPV and our group does
syndication.
a syndication, like if you talk about the difference, if
Yeah,
there
sure.
is a difference. Yeah.
So an SPV, a special purpose vehicle, think of it as kind of a robust syndication where an external third party is going to handle all the things. So obviously they're going to upcharge on filings and accounting and this and that. With us, we're working closely with a securities lawyer and a great accountant, and so we're able to bring the cost down. It's more lift for us, meaning we're the ones that are kind of managing it versus using a third party, via an SPV. But it's something that we're happy to do. Basically, they're one and the same ish. We are maintaining the cap table or the ownership of the LLC or the syndication. Where with an SPV, I do believe that they may actually flow through to things like Carta, but we're maintaining it on our end. So it's just a much, much more price efficient vehicle. And it's something that we have, much more transparency and visibility into kind of what it is, how it's operated, all those things. Great question. But I want to comment. I think Dr. Edong, touched on a few things that were pretty interesting. I think the fact that we come from different backgrounds in the collaborative approach versus groupthink of we all went, we're all Wall Street or we're investors doing X, Y, and Z. It's really tremendous. Additionally, being predominantly women, looking at women's health deals and having truly an environment where people are encouraged to speak up and say, I'm interested, or, what's going on there? Or, hey, I'm skeptical about that culture. You're not seeing that with the other groups that are, let's just say, lacking representation, gender and otherwise. And so I do think there's something really fantastic, our marrying of the qualitative and quantitative, where we're making good investment decisions, but we're also a wealth of knowledge and not just that data room or that spreadsheet or the, locker room talk of, what that CEO says. And gosh, every time I've said no to an investment because I see a lack of or misalignment of, culture or values, I never think twice about saying no. Like I'm thrilled to say no, and I'm thrilled to walk away from those. And it's not that we always invest in every women's business or every do-gooder or anything like that. But I do think there's something really tremendous about us coming at it from, this brain power and, analytical framework, but also as humans who have empathy and, care about alignment as well. Future of investing. Thanks for sharing, Jackie. And so we have, regular events where y'all can plug in and learn more, whether it's office hours, whether it's, session 3. I will give a shout out. We have an upcoming pitch day in June. And pitch day is, gosh, one of the, as Rachel calls it, it's like a holiday. It's like we get all together and it's fun and all that amazing work that Rachel Edong and everyone in She's Independent has done. We're curating a really quality list of companies that are pitching us, and there's, a lot of opportunity for interaction, engagement, and investment. So it's something really fun that's around the corner. Thanks for dropping that link in the chat, Rachel. I know we're coming up to time. Any final thoughts, questions? This was a lot of fun. And I know we have some quiet folks on, but again, if you just want to drop anything in the chat or come off mute or come on video, we welcome it. Thanks, Pam. Pam's another one of our members. Well, I love that we have some new faces, or I should say new names. We didn't see all the new faces. Hi, Jackie.
Hi. Hey, so I do have a question, and I probably could go research this on your website, but
Yeah.
I mentioned I joined because a friend of mine had an event and I learned about you. So what is a member? Is that just anyone who invests through you, or is there like
That's
a
the question.
difference in you choose to do something,
Yeah, no,
but you're
it's
not doing a lot of things?
So our membership model is basically, if you're a member, you're going to get access to all the things we do. We're unique in that we're not only here just for those that already have capital, but we even have a path if somebody is not yet accredited, meaning they're not yet in a position to allocate to private investments, or maybe they're just not ready. Let's call it what it is. A lot of women out there, and I've seen it again and again, it's
Mhm.
I have the money, but I'm not quite there. By the way, you change your mindset when you write the check, right? But either way, we're here for you, even if you don't have the capital or if you're not yet ready. So that tier is called Investment Observer, where you can be a part of it. You can be on the learning, you can be, getting mentorship, you can be on these deal calls. But you can't be in live pitch rooms if you're an investment observer. That's the one stipulation. You will get
Okay.
access to recording. The investment member, you have to be accredited, but you also get access to all the things. So really the difference between those
Mhm.
two is, are you accredited, and if you are, and if you're not yet ready to be an investment member, you can start as an observer. We've had folks graduate. There's also what we call an investment couple or investment household. So we've had sisters join, we've had couples join, same sex, different sex, mom, daughter. So, there's a few different tiers there. And truly, being a member with us, everything's accessible. And it's really just about, how much you want to engage. You can also be more passive. Some people will just write a check. Great. But, Rachel and Idong, are part of driving these really incredible deal calls. We're truly weekly. There are these sessions where we're talking about deals, we're talking about investments, we're talking about deal sourcing. So if people want to be a part of that, they're welcome to.
Thank you.
Thanks, Susan. And actually, I will not be on the weekly call. I have surgery, but Rachel will be kicking us off.
We'll miss you.
Well, thanks all for showing up. Again, on a Monday, I'm impressed. Is this our new time to meet? Monday afternoons? Monday mornings? This was great. It tells me, hey, there's a real need for talking about Angel and getting more folks into it. Thanks, Esther. Thanks, Shreya. I hope I'm saying that right. Pleasure. Please be in touch if you have questions. We look forward to hopefully investing with you or just seeing you at another event.
Thank
Bye.
you.
Thanks. Bye, Latha. Bye, Porba.
Thank you.
Thanks, Angie.
Thank you.